And we are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. I do have Mike here with me in the Zoom room. We are ready to begin his presentation on time at 11:50 a.m. That is Eastern Time, coming up in just a few short minutes. Thank you all so much for your patience. If you're looking for something to do while you wait, feel free to check out Turner Capital Investments virtual booth. They do have some information above the video player, and if you scroll underneath, you'll also see some downloads available, as well as a way to request more information from their team. Once again, we'll be getting started in just a few short minutes, so thank you for your patience, and I'll let you know when we begin. For those of you who are just joining us, welcome. We will be getting started here in just a couple of minutes. This session will begin on time at 11:50 a.m. Eastern Time, and I do have Mike here with me in the Zoom room ready to go. Thank you so much for your patience, and be sure to check out Turner Capital Investments virtual booth while you wait. Hello, everyone, and welcome to the session. I am pleased to introduce Mike Turner. He's the president and professional portfolio manager of Turner Capital Investments. Now, Mike takes a disciplined, rules based approach to trading through the use of his unique market directional investments. Now, to our live viewers, please share any questions that you may have in the chat box. It's located on the right hand side of the video player. And with that said, Mike, I will hand the mic on over to you, but I'll be right here if you need me.
Thank you, Charlotte. Hi, folks. Delighted that you have taken the time to join me this morning. Got a lot of things to kind of talk about. The concept I'm going to go through today is about dynamic correlation, which is really a term that I have coined versus typical diversification. And I'm going to tell you what those mean and the impact that they have in maybe your thinking about how well your portfolio is diversified. In tomorrow's session, I'm going to kind of get into a lot more detail about how they work and how that actually comes about. So if you're intrigued at all about what I'm going to discuss today, then I hope you have time to attend the session tomorrow, because we're really going to dive a lot deeper into the process. So let's get into it. So we're going to talk about in the next 30 minutes how dynamic correlation actually embraces unpredictable future market conditions. I want you to understand that that's important. That most people think, most investors think that it's a really good idea to do a lot of research, and I'm not saying there's anything wrong with that, to try and figure out where best to put your money and how to invest based on what is likely to happen in the future. Because you know, and I know, and everybody knows that the future is very unpredictable. And we can all guess about what is likely to happen, but none of us know. Are we going to have nothing but a bull market the rest of the year? Is it going to flatten out? Are we going to have a bear market? Will that happen? I was at a meeting a week or so back and was talking to a very, very knowledgeable individual. And I said, well, we don't know whether we're going to have a bull or bear market going into the near-term future. And he comes back and he says, well, I know we're not going to have a bear market. And I said, really? You really know that? And when we really got into it, of course, he did not know. No one knows. We're going to talk about how dynamic correlation succeeds in both bull and bear markets when traditional correlation or diversification does not, and why dynamic correlation solves the biggest weakness of traditional diversification. So I want you to kind of think about your portfolio, where you've got your money invested right now, and ask yourself the question, is it diversified? You may say, well, I don't know. You may say, absolutely, it's diversified. And I'm going to kind of get into the detail of both of those to talk about why you need to know if your portfolio is diversified and whether it's important or not, and whether it actually is or not. So let's get into that. So first of all, we're going to talk about, is your portfolio correlated to the market? And here's an easy way to figure that out. Very easy. If your portfolio goes down when the market goes down, and I'm not talking about a little bit, I'm not talking about a week or two or three, and we have that's volatility. But if we get into a downtrending market and it goes down 30, 40, 50, 60, 70%, and that hasn't happened in a while, but it has happened in your lifetime. It has happened in the last decade, certainly. Then if your portfolio goes down in a bear market and up in a bull market, then your portfolio is correlated, and you want it to be uncorrelated. It is correlated to the market, period. And it doesn't matter how many stocks you own. Owning different stocks is not going to guarantee diversification. It doesn't matter how many sectors that those stocks span. Owning different sectors where you think that they won't all go down, you're going to think about how they keep your portfolio from going down. They won't. Oh, they may keep it from going down as much as the actual market goes down. That's not diversification. That diversification primarily is designed to help you have an uncorrelated to the market portfolio. Simple as that. It doesn't matter how many asset classes you hold. If every holding moves with the market, your entire portfolio is correlated to the market. When the market falls, everything falls together. The question isn't how many things you own. The question is what happens to all of them when the market turns against you. Now, some of you are going to have fixed income and you're going to say, well, that doesn't go down when the market goes down. Okay, I'll give you that. But I want you to look at how your portfolio overall, you took all of the money that you've got at work in the market right now, and you said, okay, I'm going to look at it as a whole. And if the whole market goes down significantly, will your portfolio go down significantly? I'm going to show you how to keep that from happening. Some of you are going to raise your eyebrows and say, yeah, Mike, we've heard that before. No, I'm going to show you how this works. And I think you're going to get a lot out of it. Sector diversification does not equal safety. Does your portfolio move up in bull markets and down in bear markets? We already covered that. Maybe you're in tech, healthcare, energy. Everything rises together. Sector spread looks like it works, but in a bear market, tech and health and energy all fall. So that doesn't mean it is immune to a falling market. You want to have a portfolio where you make money or you at least are in safety when the market turns against you. What you really don't want to have happen, and I'm going to get into this in some detail, you don't want to lose money. You don't want to lose a lot of money. Most investors believe spreading holdings across tech, healthcare, financials, and energy protects them. It doesn't. In every bear market since 1990, most sectors fell simultaneously. 20 stocks across 10 sectors means the following. You have the same bet repeated 20 times. Okay. So what happens when the market falls? The loss. Does a market decline reduce your portfolio value? You know that. You know whether it does or doesn't. You would not be listening to me today if you didn't already know that answer. You could say if the market goes down 60, 70%, and some of you are saying right now, oh, it's never going to do that. Well, you can go back in time, not too far, and see where it has. Okay. It doesn't happen very often, but it does happen. Will it happen in the future? Probably. Do I know if it will or won't for sure? Nope. Neither do you. You should have a portfolio that has plans for your capital if it does. Okay. So let's talk about a recovery. You need a much bigger gain just to break even. If you go down 50%, you have to make 100% to get back to even. You go down 70, you have to make 43 to get back to even. The bigger losses create a much bigger mountain to climb, and it kills compounding. You know, it's interesting. I'm an engineer by my background and software systems development and finance. Okay. But it is amazing to me that the real magic in a portfolio is not what you own and how well it moves up in a bull market. It's how to avoid losses. Big losses kill your compounding, and compounding is the magic in a portfolio. If you can compound every day, in other words, if the market goes up, you go up, but now you've got more at work the next day than you did the prior day. And when that goes up, you make more. You're making more every time you have a gain. But when you have a loss, that stops it. You stop the compounding. You have to wait for your holdings to get back to even before compounding starts mattering again. Okay. The goal is to avoid large drawdowns, period, not just recover from them. So there's no need to forecast or guess. Oh, now there we go again. I throw out something that you're going to have a hard time with. I know you are a qualified investor. You're a savvy investor. You've been at this probably for years, if not decades. You really kind of know, not kind of, you know how to be in whatever investments that you're in. And I come along and I say, well, whatever you're doing, you need to stop forecasting what's going to happen next. And that just doesn't make any sense. I know that doesn't make any sense. You've spent your whole life. Every financial firm spends all their time, not all of it, certainly, but a lot of their time trying to figure out what's going to happen in the future and then put your money to work accordingly. They don't know what's going to happen in the future. In bull markets, you go long. In flat markets, we go to safety for our clients. And in bear markets, we go long again. How do we go long? In inverse index ETFs. In our world, the objective is this. Are we in a trend? Because it's either in a trend or not. We don't care whether it's a bull trend or a bear trend. You care. Just about everybody in the world cares about the kind of trend. And if it's a bull trend, everybody's happy. If it's a bear trend, it's kind of like, well, how long will this last? Do I hold on? Most people will hold on and hold on and hold on in a bear trend, thinking it's going to turn around. And when it doesn't, they finally get out with big losses, and almost immediately the market turns around. And so they hang on and hang on, waiting for the market to turn around, and they finally give up because of all the pain that they're suffering too late. Okay. What we do and what dynamic correlation does is it looks for the trend. Is it a bull trend? Is it a flat trend? Or is it a bear trend? If it's a bull trend, we're all in, 100% in. If it flattens for very long, we exit to safety. What does that mean? We take our clients' capital, 100% of it, and move it into interest-bearing securities. Okay. If it's a bear market, we move out of that safety area and we go long in inverse index ETFs. So we make money in bear markets for our clients. We make money in bull markets for our clients. And we make money in flat markets by being in interest-bearing capital appreciation accounts. Our goal is to protect capital and seek opportunity in all market environments. I know this is a tough thing to say, but it's the truth. Wouldn't it be fun if you were just as excited about bear markets as you are bull markets? You're not. I'm going to guess everybody listening to me today is not. You love bull markets. Market's been booming. Okay. We're taking advantage of that. We're having a great time. But if the market goes into a situation where it's time to go to cash, and in our world, go to cash means go into interest-bearing types of investments, then we go to cash and we wait for the next trend. Don't care whether it's bear or bull, for the next trend to occur. Okay. So dynamic correlation enhances diversification. Two fundamentally different approaches. Together, they offer growth potential in bull and bear cycles. Diversification, traditional diversification, says own many asset classes at all times. Reduce risk by spreading capital, reduces returns, hopes to lose less when markets fall, and correlation spike and crashes, meaning that when the market crashes down, correlation becomes a terrible thing. You lose money. And so you're looking for your advisor, or you, if you're your own advisor, and you're saying, I'm going to try to anticipate when the next bear market is going to happen. And you can guess and you can say, well, I'm going to move out of this equity into that one. I'm going to try to hedge my bets. I'm going to try to be diversified. Okay. That's a really hard thing to do, particularly when you know and I know nobody knows what the future is going to do. No one knows how to consistently and accurately predict the future. We don't at all. In fact, we have nothing in our methodology that does any prediction whatsoever. Now, tomorrow, I'm going to go into some detail about how that works. It is amazing. I think you'll be blown away by it because it works extremely well. This methodology blows the doors off of any kind of buy and hold. And some of you are buy and hold. You think, well, if I hold on to, and the market has always gone up, you go back to the 20s and 30s and all the way up to current time. The market eventually always goes higher. That's fine if you can handle the drawdown and if you can handle the pain along the way. Most people can't handle all that. Okay. Dynamic correlation, on the other hand, adapts exposure to the market. If the market goes up, we're in, all in. If the market goes down in bear market, we're all in long, not shorting. We're all in long inverse index ETFs. We capture the full upside in bull markets. We exit to safety and when markets reverse, and we get the full upside in bear markets in our methodology. So most advisors offer you diversification, which means you lose less when markets fall. No, we don't like that idea. We offer dynamic correlations, which means we take advantage of both bull and bear markets, and we sit safely on the sideline when it's in between. Okay. So dynamic correlation, it's a better answer. Long when the trend is rising, out when it breaks, in versus ETFs when it's sustained, decline is confirmed, and here's what that looks like. We have a strategy. This is what the S&P 500 has done since what, 1990. It's up 21 times, 2.1 million. So you put 100K at work, okay, back in 1990. Now, this is a log-based chart, so keep that in mind. In our 1X, when all we are doing is the following, well, there's no leverage in this, there's nothing. We just take the S&P 500, okay, and we are long when we're in when the bull market is running. We're in inverse index ETFs when it is in a bear market, and we're sitting in interest-bearing accounts when we're in between. And in that same period of time, instead of being up 21 times, we're up 129 times. Now, I haven't had this system in place since 1990. These are hypothetical, taking our rules that we've got right now, going back in time and looking at the price of the stocks, of the indexes, okay, the S&P 500, and we're applying that to that index by the rules that we have now. We've applied in the past. We don't go back and do curve fitting. We don't go back and do data mining. We take the logic of our current methodology and simply take it and run it against the market from 1990 to current. It's easy to see at the 1X, the 13 million as opposed to 2 million is a pretty good jump, over 6 times. Now we have a 2X version. That means we're taking leveraged index ETFs, and this is where most of our clients are, by the way. They take the 2X, which means the market goes up about, when the market goes up 5%, and the 2X will go up about twice that. Now, leverage, and I know that you've heard about leveraged index ETFs, and you think that there's too much risk in them and that they're only designed for day trading. We don't do day trading. In fact, in our methodology, we only do about 2.5 trades a year. 2.5 trades a year. And look at that. For the 2X, we're up 772 times as opposed to 21 times for buy and hold. Well, we even have a 3X. 3,557 times greater than 1X. Am I promising you that kind of return? No, I'm not. I'm just telling you how the numbers work. And do we always go up? No, we don't always go up. When you look at, and see if I can draw this or not. Okay, right here, look how it went down in that area. Okay, the market went down. Okay, not as much as the 3X did, but look at the gain over that period of time. The 2x went down in that period of time. Okay. The 1x went down in that period of time. So I'm not trying to say to you that it doesn't go down. It went down about the same as buy and hold. But look at the difference in gain. Yes, there's risk in it. There's more downside risk than in 3x than there is in 1x or 2x. Yes, that's true. But look at the return. Okay. Hypothetical. This is hypothetical. Taking the rules that we have right now today and going back in time and applying those rules to the market over time. Okay. All right. Let's see if I can get out of this now. I'll turn that off. All right. See if I can go forward now. Well, there we go. Still got the drawings on there. Let's see if I can get those off. Not sure I can. Anyway, hopefully those will stay. This is who we are. This is me. You recognize me. Um, this is my grandson, Alex. Okay. This is my daughter, Amy. We run the company, not a big company. We've got about 125 to 130 million under management. I've designed the methodology, but we know how to be bullish or in bearish or in cash. And keep this in mind. Position matters more than the holdings. Okay. And let's see if I can get rid of that. Clear all drawings. There we go. All right, I figured it out. Let's go to the next one. How our methodology works. Well, there's a lot on this screen, too much on this screen, but I'm going to kind of briefly go over it. First of all, we look at weekly data. We don't deal with day to day or hourly or day trading or anything. Like I said, we only do about 2.5 trades a year. So we look at the market entirely from a weekly perspective. We only trade the S&P 500 and the NASDAQ in the 1x, 2x, and 3x, okay? Everything is rules-based, logic-based. We don't do any data mining. When we decided to build this system, when I began designing this system, with a lot of help from AI, by the way, there was never going back and saying, okay, let's look at the history of the market and build a set of rules that work really well with the market. That's a waste of time. That's pretending that past performance equals future return. No. We just use logic. Our buy rules, very simple. Now, there's elements to it that are different, but I'm going to give you one major component of the buy rule. We want to buy low and sell high. Who doesn't want that? You want that. I want that. All my clients want that. So it's a rules-based system that is based on the state of the market, where it is, the position of the market. We implement our rules and we monitor it continuously. 1, 2, 3, 4, 5. Those 5 things, okay? So our rules are designed to protect capital and capture opportunity in both bull and bear markets. Oh, by the way, you know what our rules are for exiting? Time to get out? You would think, well, we've got all these great rules for telling us when the trend is in place, when the momentum is in place, where the market is, and I'll get into a lot more detail with that tomorrow. We get out to protect capital. You know, when we analyze the market and we look at all of our clients, and we've got hundreds and hundreds of them, and we ask them, what's the most important thing to do in managing your money? Most of them will come back and say, well, I want you to make me money. Okay, what's another thing that's important? I don't want you to lose me money. And I said, okay, of the two, making money or not losing money, which is really the most important? And they almost all come back and say, don't lose me a lot of money, but I want to make a lot of money. That's what we do for our clients. And like I said earlier, I can't promise you that if you put money with us, that we're going to make you money the next day. But I can tell you that our rules are set up to make money and to protect capital over a long period of time. We don't predict, we follow rules. The rules keep us disciplined, so we stay in the game. We have long rules, we have short rules. Okay. And we have exit rules. And the exit rules are based on, oh, by the way, when I say short, we don't actually short. Remember, we're long in both cases, but we're in inverse index ETFs when we're short. We have a short objective. Okay. So, anyway, moving ahead, here's the power. Here's what I want you to think about. Let's just say, for sake of argument, that you've got, I don't know, roughly 80–90% of your portfolio is correlated to the market. And you should be able to determine that on your own. You really should have some part of your portfolio in an uncorrelated or dynamically correlated structure. So here is an example of taking a portfolio that's 100% the S&P 500, that's the bottom line, and you take 20% of that using just our 1X strategy. That increases your return from 43%, roughly, I'm going to use percentages here, let's say 43 million, assuming you put 100,000 to work, but let's not worry about that. And it almost doubles, in fact, doubles it by just putting 20% of your money into a 1X strategy. The 2X reduces your overall loss. If you lose maximum drawdown, let's just say that, I'm going to buy and hold, your maximum drawdown over the past 36 years, push the wrong button, is your maximum drawdown is 56%. With a 20% allocation to a dynamically correlated system, you're down less than half that. Okay. You're down in a 2X a leveraged one. You're down. I keep pushing the wrong button. You're down less than half, way less than half. And in a 3X, you're only down 35, less than 35% instead of 56%. So it's a huge difference. Okay. Now, is technical equity right for you? That's what my system is. 1X is no leverage, 2X is double leverage, 3X is triple leverage. So 1X is considered by the SEC to be our lower risk model. 2X is our kind of moderate or middle ground, and 3X is our higher leveraged, higher risk environment. And that's based on drawdown. Personally, I don't like looking at drawdown as being an objective. I know that most people do. What's the maximum loss? And that's true. But I like to compare drawdown to gain. And my gain in 3X, me personally, I've got 100% of my investable capital in 3X. I like the upside and I can handle the downside because of the offset of the upside. So I look at it just in the opposite way. I really think 3X is the lowest risk to gain model. 2X is about moderate, and 1X is the highest because of the lower amount of gain compared to the downside potential loss. So you would want to kind of think about that. So next steps. If what I've talked about to you today makes any sense at all, and I've gone through enough stuff that probably you're saying, I'm not sure I got all that, Mike. Okay, then we need to talk. So schedule a call. I'm going to give you some numbers here and way to contact us. Okay. We'll review where you are and talk about whether or not it makes sense to add some of what we do to what you're already doing. We can explore some options, walk through potential allocation scenarios, and we can align and move forward if it makes sense to you. If it doesn't, no big deal. This is not going to be right for everybody. But I really think that you ought to seriously look at your portfolio, determine how correlated it is to the market. My guess is it's pretty correlated. And you need to have something that makes you money in bull markets and makes you money in bear markets. And when we're in between, makes you money. That's what our methodology is designed to do. Okay. So minimum account with us is 50,000. Okay. The money's custodied at Charles Schwab. There's the contact location, information, info at Turner Capital. If you send an email to info at Turner Capital and say, I want to talk to Mike, I will personally get in touch with you. Okay. And don't forget that tomorrow at 12:25 Eastern Time, I'm going to get into a lot more detail about how our methodology actually works, how decisions are made, how we look at the three things that makes all the decisions: where the market is, how it got there, and how strong it is. Okay. So, Charlotte, I think we're about done. Were there any questions along the way?
Fantastic, Mike. Thank you. I do have a comment here from Tony in the chat. He made this comment about 10 minutes ago. He said, my 2 times version started January 1st of 2024. And after a bit of a wobbly start, it is now up 49.6%.
Yeah, and you know what's interesting, Tony? I got an email this morning from a client of mine, and he was talking about how he'd been with me, I think, close to 3 years, and he was up, I think he said 57%. And he said, but the market itself, the S&P 500, has been up nearly 100% in that same period of time. How do you account for that? So I went back, taking our current rules, not where we started 3 years ago. This set of rules that I have developed actually began development about 3.5, 4 years ago. And that in that early stage, it's not nearly as well put together as it is now. But I took the current rules that we have now, and I went back and ran them over the last 3 years. And we more than doubled what the market had done in that period of time. So, yeah, we've done really well in the past 3 years. But 3 years ago, 2 years ago, a year ago, that version of our methodology was not nearly as good as what we have now. We're continually looking at how we can go about improving our methodology. Yes, I wish I had had this methodology 20, 30, 40 years ago. I would have loved that to happen. The whole concept of how you don't have to forecast, you don't have to project, you don't have to estimate, you don't have to guess about what the market's going to do for this methodology to work and work extremely well. Nothing in these rules that I've developed does any forecasting. Nothing. Does no projecting at all. Does not say anywhere in it, well, this is a really good looking whatever, company, index, whatever, and based on politics or Trump or the war in the Middle East or interest rates or the Fed or anything else, based on that, it's going to be better in the future. No, we don't do any of that. We take where the market is, which is the sum total of every investor in the world buying and selling. That's where the market is. Then we take how it got there. That's the trend of how it got there. And then the third piece is how strong is that trend? Those three things tell us all we need to know whether to be in the market or how we're in the market and when to get out. Okay, Charlotte, anything else?
That was all for today. But Mike, thank you so much. It was a fantastic presentation, very informative.
Appreciate it, Charlotte. Folks, I really appreciate your time. I look forward to chatting with you tomorrow, or send me an email and I'll get back to you. So you take care. Have a great day, great rest of your week. Bye-bye.
Thank you. And to those watching live, as Mike had mentioned, he will be joining us again tomorrow at 12:25 p.m. Eastern Time. Those of you watching live, be sure to stay tuned as we have a lot more in store for you in this Money Show Virtual Expo. I hope you enjoy the rest of your day. Take care.